This week, we are jumping straight into an analysis of Bitmine Immersion Technologies, BMNR. The report argues that its PE ratio of 2.34 means it's severely undervalued because of its huge Ethereum treasury. And I have to say, that is a powerful contrarian hook right from the start. It immediately challenges that whole value trap perception.
Oh, absolutely. The foundation is solid. I mean, you lay it out so clearly. BMNR's market cap is what, about 13.3 billion?
Yeah, and its asset value, because of all that ETH, is also right there at 13.3 billion. So it's trading flat, 1 times book.
Exactly. And when you put that next to, say, MicroStrategy, which often gets a 2 or even 3x premium on its Bitcoin, the gap just feels huge.
It does.
But that's where we have to anticipate the pushback. The immediate question from any savvy reader is going to be, okay, so why? Why is the market refusing to give it any premium?
And that brings us to our first point.
Right. The analysis report needs to more aggressively incorporate the massive share dilution history into the core valuation thesis, rather than just, leaving it for the bear case section.
So you're saying it feels a little structurally disconnected?
It is. The weakness here is really about placement. The material is correct. It notes the insane share dilution going from about 25 million shares to over 400 million.
Which is just monumental.
It's monumental, but that fact is buried pages later in the risk section, and by separating that history, that, let's be honest, bad behavior, from the main valuation argument,
You're missing a chance.
you're missing a crucial chance to get ahead of the main counter-argument. It makes that hidden value story feel a little bit fragile, because the whole time you're reading, you know there's this giant elephant in the room that hasn't been dealt with.
I see that. Is a structural choice that weakens the opening punch. But if we pull the dilution story right up to the front, how do we stop it from sounding like we're just making the bear case for them?
That's the key. You don't frame it as a concession. You frame it as the reason for the discount. So my suggestion is to directly integrate the dilution history into the hidden value narrative itself. Establish a clear dilution discount factor.
A dilution discount factor. I like that.
Yeah. You confront the market's punishment head-on, right in the valuation section. Then the report can pivot from just saying, hey, this is undervalued, to actively arguing how much of that undervaluation is justified, and more importantly,
How much is excessive?
exactly. You turn the dilution from a weakness of the stock into a core variable in your recovery thesis.
That's a really powerful reframe. It turns a history problem into a math problem, an opportunity you can calculate.
Precisely. And for a concrete example, you could do this. First, calculate the stock price if BMNR traded at MicroStrategy's 2x premium. Let's just say for argument that's $65.
Okay.
Then you state explicitly that the gap between the current price, around $31, and that theoretical $65 is the market's dilution risk premium. You're actually putting a number on the market's mistrust.
I love that. It makes the argument feel so much more rigorous.
It does. And second, you can reframe that blue sky $80 target. Don't just present it as some recovery. Frame it as the price BMNR hits once the market believes the dilution is over and starts pricing the assets at a 2.5x premium.
So the price moves when the dilution discount shrinks?
You got it. You're tying the price target to management regaining trust. It brings a human element into what's otherwise a very technical report.
Okay, that's smart. Let's move to the hook itself, that PE anomaly. The crucial explanation of why the PE is 2.34 needs to be elevated and clarified immediately to maximize the impact of the entire analysis. Right now, the weakness is that the report says the low PE is caused by, quote, massive net income of 328 million plus driven by unrealized gains, which is, factually true.
But
But the report spends way more time describing the result, the 2.3 PE, than it does explaining the specific accounting mechanism that creates it. For anyone who isn't a deep gap expert, that phrase unrealized gains might not immediately click.
They might not understand that it isn't real cash.
Exactly. They might not get the non-recurring paper-only nature of it. And that vagueness kind of dulls the edge of your whole Wall Street is wrong argument. A reader might just think, well, they look profitable, so what's the big deal?
right, we have to slow down and really hammer home what that $328 million is and isn't. The low PE makes it look like BMNR is a cash printing machine from its operations, but it's an illusion.
It's an accounting artifact.
It's like saying you made $1 million because your house went up in value. It's great on your personal balance sheet, it hits net income, but you can't, pay your grocery bills with it.
Right. It's just appreciation of the Ethereum they already have.
And since the whole point of the analysis is that Wall Street's algorithms are wrong, we have to turn this technicality into a super sharp, undeniable point.
Okay, So the suggestion for improvement here is to dedicate a short, high-impact section right after you introduce the 2.34 PE to explain that gap distinction, the difference between reported earnings and operational earnings.
Yes.
By making that distinction razor sharp, you prove your thesis. You show what the operational PE actually is if you strip out those paper gains. You're basically showing that the $31 price has nothing to do with operational success,
And everything to do with the assets on the balance sheet.
which is the entire point you need to prove.
And this is a perfect spot to bring in a new metric to clarify things. For a concrete example, you could 1. Introduce something like price to operational cash flow, or maybe an adjusted PE that just yanks that $328 million paper gain right out.
Show the before and after.
Yes, show that if you remove the gain, the PE would just skyrocket to a level that suggests, a dying business. And that contrast immediately tells the reader, okay, I get it. We have to look at the balance sheet, not the income statement. It's like flipping a switch.
And as a second, simpler point, just be consistent. Always label that $328 million as an unrealized paper gain or asset appreciation in those first sections. Just that repetition alone will drill the point home and get rid of any ambiguity.
That's a critical refinement, I think. Sharpening that definition is key. Okay, let's talk about how we apply this. The report does a great job setting up a trade, but we can make it tighter.
Right.
The technical analysis section should be integrated conceptually with the fundamental asset valuation to strengthen the argument for the hard floor at $30.
Okay.
So the weakness is that section 3, the technicals, it presents some great, really actionable levels. It calls out that support zone between $28.50 and $30.
Which is super helpful.
But those levels are treated just as lines on a chart. They're separate indicators, and they aren't explicitly linked back to the core premise of the entire report, that the stock is trading at 1 times its book value.
I see. So for a volatile stock like this, a line on a chart might not feel like enough protection. Investors want something more solid under that floor.
Exactly. It's a missed opportunity to establish that value floor as a product of both the chart and the quantifiable balance sheet.
They need to reinforce each other.
They have to. Technical levels can break in a panic. Mathematical floors are much harder to break in a good analysis. So the suggestion is to explicitly marry the technical analysis with the asset valuation math. You need to frame that technical support as the market's visual confirmation of the calculated asset value.
So you're making the chart prove the fundamentals, and the fundamentals prove the chart.
Precisely. You get the technical analyst and the fundamental analyst to nod at the same time. So, for concrete examples, first, just state it clearly, maybe in bold, right at the top of section 3. The $28.50 to $30 support zone is the physical manifestation of the 1x book value threshold.
Oh, I like that. Physical manifestation.
Yeah. Then you add, this offers an attractive risk profile where the downside is protected not just by chart history, but by $13.3 billion in assets. Now the floor is mathematical, not just psychological.
That's much stronger.
And second, translate the upside targets too. Instead of just listing 5350 as a gap fill target, add that the 5350 target corresponds to roughly a 1.7x book value premium.
So you're constantly reinforcing that the path upwards is just the stock capturing a fraction of the premium that a company like MicroStrategy already gets.
Exactly. You're using technicals to measure the fundamental recovery. It ties everything together.